Joining us this morning here on set, we have Torsten Slok joining us from Apollo and Piper Sandler's chief investment strategist, Michael Kantrowitz. Good to see you guys. Happy Friday. T, you've been so constructive on the economy at large. You put out notes every week arguing the economy, in your words, is just fine.
Well, as David was just saying, the guidance in terms of CapEx is still quite strong. I mean, the Magnificent Seven, their investment in CapEx has been very, very strong. So overall, on the firm side, businesses are still spending. The AI story tailwind is still very strong. On the consumer side, there are certainly some issues when it comes to consumers that are highly indebted and impacted by higher interest rates. But across the board, the latest retail sales was strong. GDP in the second quarter was 2.8. And if you look at the labor market, there are just no signs of layoffs. So that brings you to the conclusion that where is the slowdown everyone is talking about? I do understand that immigration is up, and that's driving the unemployment rate higher because labor supply is going higher. But broadly speaking, it's just not clear to me that the economy is slowing down this way that justifies 4 rate cuts the way the market is pricing at the moment.
Michael, how does your view rhyme with Torsten's, if at all, and what does it mean for the stock market?
Yeah, well, I think it's a very bifurcated backdrop still, and I think we're seeing more weakness creep up from the bottom half than strength trickle down from the high-end consumer or businesses. So, I think we could corroborate all this macro data, which I think, there's enough strong data and there's enough weak data to pick your own narrative. But if you look at the earnings data, and particularly in mid-cap stocks and small-cap stocks, the most economically sensitive groups, their estimates continue to fall. In fact, estimates for this year are now below realized earnings of 2023, and 2025 earnings are also continuing to come down. That said, large cap stocks, which have certainly been the strength of the market, their earnings continue to remain resilient, and they will be the last to fall and won't fall until we really see a bigger decline in the labor market.
And that's what we're seeing, Torsten. I mean, to push back on your view, we're seeing a decline in the labor market. Unemployment rate is up, job openings are down, sentiment surveys are pointing to weakness. That's the thing that the Fed is focused on.
Well, but if you look at layoffs, in the JOLT survey is at the lowest level since 2001. No one's getting fired. Same thing in the Challenger Gray and Christmas survey of job cut announcements. It's trending down. If you look at the WARN notices, which is a leading indicator for jobless claims, it's also suggesting that jobless claims will be lower over the next 2 months. So the very important nuance in this debate about the labor market is that there is weakness, but that weakness is mainly becoming an issue because labor supply is growing. It's not because people are getting fired. All indicators of layoffs are at record low levels. So in that sense, firms are not laying off workers. So where is this recession so many people are worried about?
I mean, with the consumer, there's definitely signs of slowing.
Well, hold on. Target this week reported that everything was fine. CEO of Walmart, Walmart was saying there's no broad-based slowdown for the consumer.
When times are tough, you go to Target and you go to Walmart.
Well, but if you look at the weekly data from Redbook on same-store retail sales, it's very strong. So across the board, it is completely misguided discussion. This whole idea that the consumer is crashing, there is no signs of crashing.
Not crashing. But I do have a chart on delinquencies for credit card loans, and I mean, it's way up.
But that's only for certain segments of consumers across the board. In the aggregate, the latest retail sales for consumers was just fine. So in some, I think the message today from Jay Powell, very importantly, will be that, yes, number one, we are cutting in September.
There's my chart.
But after that, we will begin to see more evidence that the data is maybe not as bad as we're expecting. And I think he also will clearly say, we just don't know yet what will happen after September. I completely understand the idea that we may be above our star and we may be restrictive, as you talked about earlier. But the question is, are we in a hurry to cut rates a lot? And the answer to that is absolutely not.
Michael, remind me, is the House view at Piper net bearish? Is recession your base case?
So our economist, Nancy Lazard, does see recession beginning in the fourth quarter. Our view on equities, we've been bullish since October of 2023 on this view that we're going to have soft locks, which is a moderation of economic activity and lower inflation, and lower rates would be very good for equities. We changed that view at the end of July with the view that inflation fear has been largely priced out, and obviously we've priced in a ton of Fed rate cuts. And now we're going to be more focused on growth data and activity data. And I think we're going to see, and what we've seen in the last month is we're going to see more of this, is a lot of realized volatility in the market. When we get good data, we're going to get relief because there's now budding recession fear. But if we see bad data, we're going to see the markets sell off, I think, equally as sharply. And so we're seeing, I disagree with Torsten's kind of binary view that everything's all great. And again, I think we can look to the markets, and it doesn't have to be a binary answer, but if you look at market leadership, we continue to see leadership in higher quality stocks, companies with good interest coverage, high profitability, better fundamentals. That's not the type of leadership you would be seeing if the economy was strengthening or strong. It's quite the opposite, historically speaking.
You want one final word, T?
Well, one final word, of course, is that remember what creates recessions is normally a shock to the economy. And that shock, of course, was COVID. It was the financial crisis. It was the IT bubble bursting. What is a shock to the economy today is the Fed has raised rates. We've been waiting for literally 2.5 years for Godot to arrive and to the economy finally begin to slow down. Why should it slow down here in August? We can still wait a good while longer. The data still continues to come in very nicely. The Fed has plenty of time to think about cutting rates.